Chapter 3 begins a two-chapter review of fundamental accounting principles. As we saw in Chapter 1, accounting and finance are closely related. Much of the data used in finance comes from accounting statements, so we need to have a basic understanding of what they contain, what the data means, and how it can be used. The 4 financial statements required in a firm's annual report include the balance sheet. It's a snapshot of the firm's financial position at a specific point in time. The income statement is a summary of the firm's revenue and expenses over a period, such as a quarter or a year. Statement of cash flows. This is an important report for finance, as it is the one that reconciles accounting statements to cash flow, and cash flow is the focus in finance. The statement of stockholders' equity is really short, but it's important because it tracks how much of net income is paid out in dividends and how much added to retained earnings. To demonstrate the use of financial statements, we're going to follow a hypothetical company, DeLeon Incorporated. DeLeon is a small snack food producer in North Florida whose specialty is pecan and nut products. In 2020, they decided to embark on a major expansion in an effort to capitalize on their high-quality reputation and compete with Frito-Lay. The company doubled its plant capacity, opened new sales offices outside its home territory, and launched an expensive advertising campaign. DeLeon's results were not satisfactory, to put it mildly. The board of directors was most upset when they learned how the expansion was going. Unhappy suppliers were being paid late. The bank was complaining about the deteriorating situation, threatening to cut off credit. As a result, changes have to be made, and quickly. Here's the asset side of DeLeon's balance sheet for 2020 and 2021. Clearly, the cash position has deteriorated significantly. Accounts receivable and inventories have increased by almost 100%. Net fixed assets has almost tripled. Looking at the liabilities and equity side, all the liabilities increased. Accounts payable ballooned by 260%. Notes payable increased by 218%. Long-term debt more than doubled. Retained earnings declined by 84%. These are seriously bad changes in the firm's position. DeLeon sales did increase significantly, 78% after the expansion, but cost of goods sold increased by 93%. Net income went from a positive $109,950 profit to a $160,000 loss, a swing of 246%. No wonder the board of directors are upset. These results from 2020 and 2021 make it clear why shareholders are not happy either. Earnings per share declined by 282%. Dividends were cut more than in half, a bad signal to the market. Most disturbing, the stock price dropped from $8.50 a share to $2.25, a 73.5% decrease. DeLeon's statement of stockholder equity is a simple statement, since they didn't issue any new stock. Beginning of the year retained earnings plus net income, which was negative, minus dividends paid, equals end-of-year retained earnings. Of note that even though they reported a negative net income, they paid dividends anyway. Dividends were paid out of retained earnings which belonged to the shareholders but were retained to reinvest in the firm. Let's look at the last of the 4 main financial statements, the statement of cash flows. Why is it important? It's an important statement since it's the only place where accounting numbers are reconciled to cash. Accounting's matching principle requires estimates and accruals. Financial analysis is concerned with cash flow. Balance sheets and income statements can and are manipulated. Cash cannot be manipulated. Either you have it or you don't. A firm needs to translate sales and earnings into cash. The statement of cash flows has 3 sections. Cash from operating activities, cash from or used for investing activities, cash from or used for financing activities. The objective is to reconcile beginning of the year cash with end of the year cash. Here is the cash flow from operating activities for DeLeon. The result is negative, driven by the negative net income. This is not an accounting course, so we're not concerned with creating a statement of cash flows, only with understanding and interpreting one. Note that in general, you want a firm to make money from operations, from what they say their business is. Here are the other 2 sections of DeLeon's statement of cash flows. DeLeon spent over $700,000 on new plant and equipment. They financed it by issuing notes payable and long-term debt, yet they paid dividends anyway. When we cover common stock, we'll see that it's a very bad signal to the market to eliminate dividends. Reducing dividends is bad, but not as bad as dropping them altogether. Summing the net figures from each section and beginning cash should result in end-of-year cash. Our overall conclusions from DeLeon's statement of cash flows: net cash from operations was driven by negative net income. The firm borrowed heavily to finance their growth, and even after borrowing, they still dipped into cash. This steps through the statement of cash flows. Beginning of the year cash, plus or minus cash from operations, plus or minus cash from investing, plus or minus cash from financing, equals end of year cash. Before we go any further, we need to differentiate between two types of net working capital. The traditional definition of net working capital: current assets minus current liabilities. A more refined definition is net operating working capital, or NOWC. Net operating working capital is only concerned with operating assets and liabilities. Short-term investments, DeLeon doesn't have any, are not an operating asset. They're an investing asset. Notes payable are not an operating liability. They're a financing liability. So for DeLeon, net operating working capital is equal to current assets minus the quantity current liabilities minus notes payable. Did this expansion create additional after-tax operating income? After-tax operating income takes taxes into account but not interest expense. DeLeon's after-tax operating income swung from a positive $142,821 in 2020 to a negative $28,614 in 2021. Remember our refined definition of net operating working capital. DeLeon's net operating working capital increased by $120,960 between 2020 and 2021, driven by the increases in basically all the components. Recapping. Sales increased by 78.5%. After-tax operating income declined by 120%. Net operating working capital increased by only 15.4%, but net income declined by 246%. The formula for free cash flow is shown at the top of the slide. Note, capital expenditures is the change in net fixed assets from the balance sheet plus depreciation from the income statement, or it's the change in gross fixed assets from the statement of cash flows or from the balance sheet. Either way, DeLeon's free cash flow for 2021 is a negative $744,000. Is it always a bad sign? It's generally not a good sign, but it can occur during an expansion, which is the case with DeLeon. However, coupled with DeLeon's poor performance in other areas, it's not a good sign. So let's walk through where each element of free cash flow comes from. Right here, EBIT and depreciation come from the income statement. Current assets and both gross fixed assets and net fixed assets can come from the balance sheet. Many times balance sheets only show net fixed assets. Finally, current liabilities and notes payable come from the balance sheet. Putting it all together, there's our negative $744,564. Accounting statements don't give us all the performance information we need. Why? They don't reflect market values. Two other metrics take market value into account. Market value added. It's the difference between the market value and the book value of the firm. How much value has been added to the firm since its inception. MVA is a firm-wide measure. EVA is economic value added, and the formula is on the next slide. It's a measure of value added in a single year. Here's the formula for MVA and EVA. MVA is straightforward. Price per share times the number of shares outstanding is the market value minus the book value. Economic value added is found as net operating profit after tax minus the annual dollar cost of capital. EVA can be used to evaluate a company, a division, or a subsidiary. For DeLeon, MVA for 2021 was a minus $267,592. For 2020, it was positive $186,232. It declined by over $450,000, so clearly shareholder wealth has been destroyed. MVA and EVA are related. If EVA is positive, then the firm is earning more than the cost to produce that income. Positive EVA annually ensures a positive MVA. MVA is applicable to the whole firm only, but EVA can be calculated for a division or a subsidiary, so it can be used for annual performance evaluations. Our final topic in this lesson covers taxes, individual and corporate. Both personal and corporate taxes have been based on a progressive structure, higher income, higher rate. Individual taxes are still progressive, but the corporate rate is now, for the moment at least, a flat 21%. New tax legislation modified the tax rates for both individuals and corporations. The previous top rate for corporations was 35%, was lowered to 21%. Business interest deductions were modified as well with a limit of 30% of EBITDA through 2021 and then 30% of EBIT after. While the personal rates were lowered, which we'll see on the next slide, the reduction in the corporate rate was much more dramatic. Rates begin at 10% and rise to 37% for single individuals with income over $523,601, married couples filing jointly over $628,301. And of course, both of these can be subject to state tax. The standard deduction has increased for single individuals to $12,550, for married couples filing jointly to $25,100, causing many to now choose the standard deduction over itemizing. This was kind of balanced out. The personal exemption has been eliminated. For corporations, interest paid is tax deductible, as we've seen on the income statement. For individuals, interest earned, except on municipal bonds, is fully taxable to individuals. Dividends paid are not tax deductible for the paying firm. They're paid out of after-tax income. Dividends received are generally taxed. In the 10 to 15% tax brackets, 0. Middle brackets, 15%. Highest tax brackets, 20%. Dividends are double taxed. First, they're taxed at the corporate level, and then they're taxed at the individual level. If a firm owns a non-controlling interest stock in another firm, dividends on that stock may be tax exempt. Corporations are permitted to carry losses back or forward to offset profits. Capital gains are the profits from the sale of assets, physical or financial. For individuals, gains on assets held less than a year are ordinary income. Held more than a year, long-term capital gains. Most pay 15%, highest tax bracket pays 20%. This ends our review of financial statements. In the next chapter, we'll continue our accounting review and follow De Leon for another year.